We all begin with the same question, don't we? The one that whispers in the dark when the bills pile up and the job feels like a cage. Is there another way? Is there a path to true financial independence? A secret code buried deep within the chaos of the markets? We look at the charts, those jagged, mesmerizing lines of greed and fear, and we tell ourselves, someone, somewhere, knows the answer. Someone has mastered this game. And then we find the stories of men like Mark Minervini. But this isn't a story about overnight riches, lottery tickets, or lucky guesses. That's the lie the market tells the dreamer. This is a story about the relentless, almost obsessive dedication to a craft. The kind of focus that turns a complex, chaotic system into a repeatable, almost scientific process. It's about the transformation from a mere speculator, a hopeful gambler, into a champion. And that word, champion, carries the weight of thousands of hours, countless mistakes, and a deep, penetrating understanding of human nature. Minervini didn't just wake up one morning and decide to be a wizard. He started where most of us start, broke, struggling, and failing. His journey is the painful, beautiful realization that the market does to care about your hopes, your education, or your good intentions. It only cares about results. And the key to consistent results, the absolute secret at the heart of his philosophy, is not a mystical formula, but a radical shift in mindset. It's about thinking and trading like an elite performer in any field, a world-class athlete, a master chess player, or a champion stock market wizard. The first and most critical hurdle he forces us to confront is the distinction between a good trade and a good process. Think about that for a moment. Most people judge their trading by the outcome of a single transaction. They make a profit on a reckless gamble and feel like a genius. They take a small, protective loss on a well-researched position and feel like a failure. But a champion understands that a successful career is not built on individual wins. It's built on the unwavering, disciplined execution of a superior process. You must be willing to accept a small loss in the pursuit of protecting your capital, even when the trade feels right. Because the moment you let emotion override your rules, you are no longer a champion. You are just another emotional gambler in the crowd. This process starts with a chilling but necessary piece of self-reflection. The market is never wrong. We are. Our analysis might be wrong. Our timing might be wrong. Our assumption might be wrong. But the price action, that ruthless, undeniable truth flashing across the screen, is always right. The average trader fights the market. They argue with the price. They hold on to a losing stock because they know it's undervalued. They cling to their ego like a life raft in a storm, and that ego is the anchor that eventually drags them under. The champion, however, bows to the market's wisdom instantly. The rule is simple, yet psychologically brutal. If the stock hits your predetermined stop loss, you exit. No debate, no hesitation. You are wrong, and you admit it immediately. This leads us to the heart of risk management. Not as a mathematical exercise, but as a survival mechanism. Minervini's core philosophy is that your number one job is not to make money, but to prevent large losses. A large loss, a catastrophic drawdown, doesn't just damage your portfolio, it damages your psyche. It breeds fear, hesitation, and self-doubt, which are the silent assassins of a trading career. He teaches us to view risk as the cost of doing business. You must know your absolute maximum pain tolerance before you enter the trade. This is what separates the professional from the amateur. The amateur asks, "How much money can I make?" The champion asks, "How much money am I willing to lose to find out?" The concept is beautifully simple. Keep your losses small and your gains large. This isn't just common sense. It's a mathematical necessity. Think about the recovery effort. If you lose 10% of your capital, you need to gain only 11.1% to get back to even. But what happened? But what happens next changes everything. If you let a loss spiral to 50%, you now need a staggering 100% gain just to break even. That is the point of no return for most traders, the psychological abyss from which few ever truly recover. Minervini's genius lies in codifying this emotional guardrail. By using tight stops, typically limiting risk to around 1% to 2% of the total portfolio on any single trade, he ensures that no single failure can ever become fatal. He trades to survive first, and only then to thrive. But survival alone is not enough. We must also hunt for the truly exceptional opportunities. This is where his famous SEPA, specific entry point analysis methodology, comes in. It's not just about finding good companies. It's about finding super performance, stocks that have the potential to deliver truly enormous returns, the ones that become the engines of a high-growth portfolio. He views the market not as a random walk, but as a series of cycles, and his strategy is designed to capitalize on the sweet spot, the breakout from a low-risk, consolidating base. The stock Minervini seeks is the one emerging from a period of relative quiet, a hibernation period where institutional investors have been slowly accumulating shares. He looks for a unique fingerprint, a specific combination of factors that signal stock is ready to shift into its stage 2 uptrend, the high-velocity growth phase. This is the period where the stock moves from being simply in favor to becoming a market leader. This is the difference between a jog and a sprint, and he only wants to be in the race when the gun goes off. The 4 pillars of this search are clear: the stock, the industry, the earnings, and the price action. He demands strength across the board. The stock must show clear evidence of rising price and volume. The price action. It must belong to a strong, high-growth sector. The industry. Crucially, the company must be demonstrating accelerating, fundamental strength, dramatically increasing earnings and sales. The earnings. And finally, the stock itself must have the characteristic VCP or volatility contraction pattern, a tightening of price swings in its base, indicating that supply has been wrung out of the market and a large move is imminent. It's a synthesis of fundamental strength and technical timing, where the analysis of what to buy meets the discipline of when to buy. Minervini is uncompromising on fundamentals, often stating that you cannot have a super performer without super earnings. Price follows profits. It's a simple economic truth that the champion never forgets. He isn't interested in turnaround stories or deep value plays where the narrative relies on hope. He wants companies that are already showing the results, where the earnings, per share EPS and sales are not just growing, but accelerating. He uses a strict screening process, a filtration system designed to eliminate the merely average and highlight the truly explosive. A champion doesn't swing at every pitch. He waits for the fat, perfect pitch that is teed up for a home run, and this patience is key. The entire SEPA methodology is built on the foundation of waiting for the optimal entry point. The most common mistake the amateur makes is chasing a stock after it has already made a huge move, buying high and panicking low. The champion waits for the stock to build a solid, low-risk base, a period where the stock digests its previous gains. He waits for the precise moment the stock breaks out of this base on massively increased volume, the sign that the big institutional money is piling in. This is his specific entry point. It's not a zone, it's a moment, and executing at that moment requires both the discipline to wait patiently for weeks or months and the courage to act decisively when the signal is given. But courage is useless without control. And control in trading means knowing when to add to a winning position. Most investors are guilty of averaging down, buying more shares of a losing stock in a misguided attempt to lower their average cost. Minervini shuns this practice as trading suicide. His rule is the direct opposite: average up. He believes that you should only add to a trade that is already showing you a profit. This is the market telling you that your initial analysis was correct. By adding to a winner, you are applying capital to confirmed strength, multiplying your profits on the stock that is actually working, and letting the market do the heavy lifting for you. It's a fundamental belief that winners should run and losers should be culled ruthlessly. This idea of adding to a winner introduces the concept of pyramiding, scaling into a position as it moves favorably, always ensuring that your average entry price remains below the current market price. This strategy allows the champion to build a large position in the best performing stocks while maintaining a safe, manageable risk profile. Every additional buy point is a test of the stock's continued strength, and every successful test validates the larger investment. This is not reckless chasing. It is strategic scaling, a deliberate and calculated way to press your advantage when the odds are clearly in your favor. The champion understands that the true battlefield is not the stock exchange floor, but the mind. The greatest barrier to success is not a lack of intelligence or flawed strategy, but the crippling weight of emotional interference. Fear and greed are the two oldest enemies of the investor. Fear keeps you from buying when the signal is perfect, and it forces you to sell too soon when the stock finally takes off. Greed makes you hold on too long, turning a massive paper profit into a painful loss when the stock finally rolls over. To combat this, Minervini emphasizes the creation of an unwavering trading plan. This plan must be written down, detailed, and non-negotiable. It must cover everything: the criteria for selection, the precise entry point, the immediate stop loss, and the ultimate profit target and exit strategy. The purpose of the plan is to remove the human element from the decision-making process. When the trade is in motion, the champion ceases to be an emotional thinker and becomes an executor of the plan. The trade is no longer about what I feel, but what the rule dictates. This discipline is the very definition of professional trading. But the plan is only as good as the risk-reward ratio it is built upon. Minervini insists that every trade must offer a high reward potential relative to the risk taken. He's not interested in a trade where he risks $1 to potentially make $1. He wants trades where he risks $1 to potentially make $3, $4, or $5. This superior risk-reward profile is the mathematical engine of his success. By taking small losses and allowing the occasional large winner to run, he creates an asymmetrical return curve. He doesn't need to be right more than 50% of the time. If his average win is 3 times his average loss, he can be wrong 60% of the time and still be enormously profitable. This realization that you don't need clairvoyance, just proper risk management, is liberating and utterly transformative for the aspiring champion. This understanding of probability and risk is what allows him to trade with an almost surgical calmness. He doesn't fear the loss. He respects it. The loss is simply information, a data point that proves his hypothesis was wrong at this time. It's the cost of admission to the next great winner. This acceptance of small failure, this lack of emotional attachment to being right, is the hallmark of professional maturity. The market is an endless game of probabilities, not certainties. And the champion plays the probabilities with the cold, hard logic of a machine, all while understanding the human forces that drive the ticker tape. He recognizes that the biggest opponent in the market is not the competitor on the other side of the trade, but the person staring back from the reflection in the screen. The champion's journey continues into the deep waters of position sizing and portfolio management. It's one thing to find a great stock, and another entirely to manage the money allocated to it. This is where most traders fail to scale their success. They might have a few winners, but they never build a coherent, powerful portfolio. Minervini's approach here is meticulous, almost military in its precision. He advocates for a disciplined method of allocating capital based on the stock's technical setup and its inherent volatility. The core principle is known as inverse volatility position sizing. Think of it like driving a high-performance car. You wouldn't press the gas as hard on a winding mountain road as you would on a straight highway. Similarly, a stock that is highly volatile, one with wide price swings, must be given a smaller position size. Why? Because the tighter the price movement, the less likely it is to hit your stop loss prematurely. By reducing the share count in a volatile stock, you keep the dollar amount of your risk, your stop loss amount, consistent across your entire portfolio. This is a subtle yet profound shift. It means you are managing risked dollars, not just shares. It allows the champion to sleep soundly, knowing that no matter which stock hits its stop loss, the damage to the overall portfolio will be uniform and minimal. This uniformity of risk is the bedrock of consistency. It removes the emotional decision of thinking, "I like this stock more, so I'll bet bigger." Instead, the logic is purely mechanical. This stock is riskier, so I will take a smaller piece of it to maintain portfolio risk balance. This discipline ensures that your largest positions are, by definition, the ones with the tightest, lowest risk entry setups. It's a genius design flaw, a system that forces you to be right more often and risk less while doing it. As the story unfolds, we realize the champion is constantly managing not just individual trades, but the market environment itself. The greatest strategies in the world are useless if the tide is going out. Minervini emphasizes that trading is a game of probability, and probabilities are heavily skewed by the market trend. When the general market is in a stage 2 uptrend, your odds of finding a superperformer are high. The wind is at your back. When the market is chopping sideways or entering a stage 4 downtrend, your odds plummet, and the risk of whipsaws and false breakouts skyrockets. His advice is blunt and uncompromising. Trade aggressively in bull markets and defensively or not at all in bear markets. He uses indicators like the 200-day moving average of the major indices to determine the health of the overall market. If the S&P 500 or the Nasdaq is trading below its 200-day moving average and the 200-day line is flattening or declining, that's the market's way of holding up a gigantic, flashing red stop sign. The champion knows when to step back, to put capital on the sidelines, and protect the gains already earned. Cash in a bear market is a position, and often the best performing one. This ability to be fluid, to adapt their participation to the market, booed, is a superpower that most average traders simply lack. They feel compelled to be always in the game, a compulsion that often proves fatal. This constant assessment of the market's health also dictates the champion's profit targets and exit strategy. Getting into the trade is only half the battle. Knowing when to get out is the other, often harder, half. Greed whispers in your ear, "It'll go higher," while the stock starts to show telltale signs of breaking down. Minervini teaches a dynamic, two-pronged exit strategy. First, there is the protective stop loss, the maximum pain point, which we have already covered. Second, there is the profit-taking exit, which is far more nuanced. He advises against having rigid, round-number targets. Instead, the champion monitors for distribution, heavy volume on-down, days, and for the stocks, technical deterioration, such as failing, to hold key moving averages, like the 50-day moving average, or exhibiting a sudden, violent downside reversal on high volume. These are the footprints of institutional selling, the smart money heading for the exits. The goal is not to sell at the absolute top. That's a fool's errand. The goal is to sell near the top before the inevitable, painful crash, preserving the vast majority of the gain. The mantra is, take profits aggressively when the stock starts acting poorly. It's better to realize a slightly smaller profit than to watch a massive gain completely evaporate. The champion treats paper profits as an illusion until the cash is back in the account. And here's where everything begins to shift, moving beyond the technicals, deep into the subtle, powerful world of trading psychology and accountability. The truth is, most traders have a decent strategy, but they lack the psychological fortitude to stick to it. Minervini hammers home the idea of self-accountability. There is no room for blame. You can't blame the market, you can't blame the news, and you can't blame your strategy. Every single trade is your decision, your execution, and your result. This radical acceptance of responsibility is the key to continuous improvement. He insists on meticulous trade logging. This is the champion's training journal. Every entry, every exit, the risk taken, the market context, and, most importantly, the emotional state during the trade must be recorded. Why? Because the log doesn't just record what you did. It records who you were when you did it. It exposes the patterns of self-sabotage, the times you violated your stop-loss out of hope, or the times you sold too early out of fear. By studying this journal, the champion turns failures into lessons, transforms mistakes from emotional wounds into objective data points. He often reminds us of the profound link between physical and mental wellness and peak trading performance. Trading is a high-stress, high-stakes mental activity. You cannot operate at an elite level if you are physically exhausted, emotionally drained, or distracted by life's chaos. The champion respects their mind as their most valuable trading asset. They prioritize sleep, exercise, and a clear separation between trading time and personal time. The ability to step away, refresh, and return to the screen with a clean, unbiased perspective is non-negotiable for long-term success. The final deeply reflective layer of Minervini's teaching is about consistency and dedication. Success in trading is not a sprint. It's an ultra-marathon run at a disciplined, measured pace. The hallmark of the champion is the small, continuous edge, the relentless pursuit of doing the same disciplined things better and better, day in and day out. It's about achieving a high return on equity, ROE, with a low drawdown, maximum loss. The ultimate goal is not to be the richest trader for a single year, but to be the one who compounds wealth steadily over decades. This requires a fundamental acceptance that drawdowns are inevitable. They are part of the game. Even the best traders have losing streaks. The difference is how the champion responds. They don't panic. They don't abandon their strategy. Instead, they reduce position size, trading smaller during a losing streak, conserving capital until the market conditions or their trading rhythm returns. This defensive retreat protects the core capital, allowing them to remain mentally and financially strong enough to attack aggressively when the high-probability opportunities eventually reappear. The champion understands that true power lies not in winning every battle, but in winning the war by one, staying in the fight. The greatest war the champion wages is against the illusion of complexity. The financial world often attempts to confuse and intimidate, creating a false sense of required expertise that pushes the average person away. But Minervini's teaching is a powerful counter-narrative. Simplicity is the ultimate sophistication. He encourages us to strip away the noise, the endless news cycles, the pundit opinions, the exotic indicators, and focus on what truly matters: price and volume. These two variables are the unadulterated truth of the market, the collective wisdom or madness of millions of people expressed in a single chart. He urges us to develop a trend template, a simple visual checklist that filters out bad stocks and highlights potential leaders. This template is designed to ensure that the champion only participates in stocks that are clearly demonstrating strength at multiple levels. Imagine a hierarchy of power. The stock's current price must be above its 10-week and 30-week moving averages, a measure of short and medium-term trend. The 30-week moving average itself must be trending up, confirming the long-term trend. And the stock must be demonstrating superior relative strength, meaning it is outperforming the general market. If a stock fails this simple, elegant filter, it is immediately discarded. There is no negotiation with the filter. It is the champion's guardrail against mediocrity. But what gives a stock the fuel to move? It's the engine of earnings and sales acceleration. This is a concept that goes beyond simply good growth. A champion isn't looking for a company growing earnings at 15% year over year if last quarter it grew at 15%, the quarter before that it grew at 15%. They are looking for the acceleration. The company whose earnings growth went from 15% to 30%, or whose sales jumped by 50% unexpectedly. That sudden dramatic improvement is the catalyst that forces institutional investors to sit up, take notice, and pour billions of dollars into the stock, driving the price into a super performance trajectory. It's the unexpected surprise that sparks the parabolic move. As the story continues, we delve into the core visual tool, the volatility contraction pattern, or VCP. This is perhaps the most iconic fingerprint of a Minervini stock. The VCP tells a powerful cinematic story of market dynamics. It reflects a consolidation phase where the weak hands, the impatient, the leveraged, the nervous, are forced out of the stock, causing volume to dry up and the price swings to become progressively tighter. Imagine a funnel. The price action tightens from wide fluctuations to medium, and finally to a narrow, almost flat movements, always occurring above a rising 200-day moving average. This tightening, this contraction, is the market preparing for a massive expansion. It shows that the supply of shares willing to be sold has been exhausted. When the stock finally breaks out of this tight pattern, its pivot point on heavy volume, it's like a spring that has been compressed too tightly and is finally released. This is the low-risk entry point. It allows the champion to place their stop-loss very close to the entry, creating that coveted high risk-reward ratio where the potential upside dwarfs the immediate, necessary downside. The champion doesn't just trade individual stocks. They trade themes. They understand that stocks move in packs. A rising tide lifts all boats, but the strongest boats are in the strongest fleet. Therefore, they demand that their chosen stock belongs to a leading industry or sector. Why fight a headwind? If the semiconductor sector is booming, the champion focuses their energy and capital on finding the best stock within that sector. If retail is lagging, they ignore it entirely. This is about leveraging the power of macro momentum. By aligning their trades with the dominant market theme, They exponentially increase the probability of success and the magnitude of the potential returns. This disciplined focus means the champion must cultivate a rare skill, the ability to be bored. Trading mastery is not exciting. It is often tedious, involving hours of scanning, filtering, and waiting. The amateur seeks excitement. They want action every day. The champion seeks the perfect setup. They are perfectly content to do nothing for days or weeks until their precise conditions are met. They understand that patience isn't just a virtue. It's a source of profit. Every impatient trade taken is a subtraction from their capital. Every moment of patient waiting preserves capital for the high probability opportunity. The most profound realization the book offers is the idea of trading as a business. This shifts the entire perspective from gambling to entrepreneurship. A business requires a plan, capital allocation, risk management, and rigorous accounting. The champion approaches their trading desk like a CEO approaches a corporation. They manage overhead, commissions, and slippage. They maximize return on assets, their capital, and they treat their losses as the cost of research and development. This business mindset demands continuous analysis of results-based assumption. Minervini asks, "What are your actual numbers? What is your average winning percentage? What is your average gain versus your average loss?" Without knowing these cold, hard facts, you are flying blind. The champion must calculate their expectancy, the average dollar amount they can expect to make or lose per trade. If your system has a positive expectancy, the only thing required is disciplined, repeated execution. If the system has a negative expectancy, no amount of hope or luck will save you. This focus on objective data turns trading into a solvable, repeatable mathematical problem. This objectivity is also crucial in managing the most dangerous emotion of all, holding onto losses. This is the one violation that can wipe out all the previous hard work. Minervini states clearly, never, under any circumstances, allow a protective stop to be moved. The stop is your insurance policy. It is the line in the sand. Once violated, the trade is terminated. End of story. The moment you move that stop, you have abandoned your plan, surrendered control to hope, and accepted the possibility of catastrophic loss. It is a psychological trap designed by the market to prey on the hopeful. The champion avoids this trap by practicing a profound form of detached observation. They look at the stock they just sold for a loss, not as a personal failure, but as a piece of merchandise that didn't sell as expected. They learn the lesson, execute the stop, and immediately move on to the next opportunity. The ability to cut a loss quickly, to feel the temporary sting of being wrong, but avoid the paralyzing pain of a huge loss, is the single most defining characteristic of the champion trader. It's the ultimate act of self-preservation, ensuring that the next day they are still financially and mentally fit to trade. Finally, the champion views volatility not as a threat, but as an opportunity. While the amateur fears market choppiness, the champion recognizes that volatility is what creates the big moves and the VCP setups. Without movement, there is no profit. Their goal is to contain the risk inherent in volatility, but capitalize on the potential it represents. They understand that the quiet periods of consolidation are not dead time, but the necessary periods of tension building, the slow tightening of the spring before the explosive launch. The final essential mandate for the champion is the constant refinement of their judgment and decision-making. Minervini stresses that trading, ultimately, is a game of pattern recognition. Yet, patterns only reveal themselves to the prepared mind. This preparation isn't just about screening charts. It's about building a mental database of past super-performance moves. By diligently reviewing the charts of stocks that delivered massive gains, the great ones, the champion trains their subconscious mind to instantly recognize the optimal setup, the proper tempo of the VCP, and the necessary volume signature. This rigorous study transforms intuitive action from reckless guessing into educated intuition. It's the equivalent of a grandmaster having memorized thousands of chess games, allowing them to see the future moves instantly. The champion's most powerful asset, often overlooked by the amateur, is patience at the pivot. We discuss the importance of the entry point, but the psychological demand of waiting for the breakout, the pivot, is immense. The amateur wants to jump the gun, buying before the setup is complete, often finding themselves caught in a failed breakout or a final shakeout. The champion knows that the highest probability move occurs precisely at the point of maximum technical conviction. They don't try to save $1 by buying a stock a few cents early. They prioritize certainty over cost. Their willingness to pay slightly more for a confirmed move ensures they are trading with institutional momentum, not against it. This mastery of timing also extends to the subtle art of selling into strength, a concept that runs contrary to the set it and forget it mentality of long-term investing. While Minervini is a trend follower, he is keenly aware that all trends eventually end. His strategy is about riding the middle 80% of a massive move, not clinging on for the final volatile 10%, where the risk of catastrophic reversal is highest. He advises selling gradually as a stock reaches extended levels and begins to show signs of churning. Large trading ranges on high volume without making further progress. This churning is the subtle warning sign that distribution is taking place, that the big money is quietly exiting. The champion doesn't panic sell. They strategically scale out. They might sell a quarter of their position at a major profit target. Another quarter if the stock violates a short-term moving average. This process of scaling out is emotionally intelligent because it allows the trader to lock in significant profits while keeping a remaining stake just in case the stock continues its run. It turns the exit process from a single agonizing decision into a series of logical, manageable actions, ensuring that the champion never gives back a substantial portion of their hard-earned gains. This brings us to the ultimate secret, the champion's unwavering rules. Minervini's success is built not on flexibility, but on rigidity in the face of chaos. He provides a final list of blunt truths that define the professional trading life. The champion must never take a large loss. This is the first commandment, the line that can never be crossed. They understand that recovery from a 50% drawdown is statistically improbable for most traders. The champion always knows their risk before entering the trade. The stop loss is pre-calculated and entered into the system immediately upon entry. It is the cost of admission, not an optional expense. The champion trades with the trend, not against it. They demand that the overall market and the stock itself are moving in an uptrend, refusing to gamble on counter-trend rallies or attempts to bottom fish. The champion only averages up, adding to confirmed winners, never trying to rescue a losing trade by throwing good money after bad. They are masters of applying capital to success. The champion understands that the market is a mirror, reflecting their own emotional and mental discipline. The market doesn't reward intelligence. It rewards discipline. The final image Minervini leaves us with is not one of sitting on a beach, but one of sitting at the desk, deeply focused, meticulously executing the plan. The real reward of thinking and trading like a champion isn't just the money. It's the personal transformation. It's the journey from being tossed about by the emotional waves of the market to becoming the calm, disciplined captain of your own financial destiny. It's the realization that while the market is unpredictable, your reaction to it can be perfectly predictable, perfectly controlled, and perfectly profitable. It requires courage, the courage to admit you're wrong quickly, the courage to be patient when everyone else is reckless, and the courage to stand apart from the crowd. The champion knows that success is simply the long-term compounding result of consistently executing a superior process. It's not a secret. It's a commitment. And as you step away from the pages, you realize the power was never in the book. It was always waiting to be unlocked within you, demanding only the relentless discipline of a true champion.